Thank you very much. Happy Wednesday, everyone. Thank you for joining us for another session of RM Smart Investing. Today, I want to share, actually, it's one of my favorite subjects, and it's about technical analysis. And basically, what I thought, I'm going to make this a two-segment uh, class in a sense that I like to emphasize and work on the classic chart patterns, and then our next session we will work on modern technical analysis on the indicators, so it's kind of different each other. So I didn't want to mix them. So basically today what we're going to talk about is the classic chart patterns and classic technical analysis. So we have to differentiate this from the other things that a lot of you, when you're using your chart tools or graphs, you look at indicators, and that's more of a modern. So what the classic technical analysis means is basically it's based on purely the price. So you have the trend lines, you have the supports, you have resistance, and you have patterns. So it's very visual, and it's more on the prices. The modern technical analysis uses indicators which basically are the derivative of the prices. So there is a secondary thing. So you see the prices, but they use that to use it from the momentum indicators to volatility. And they actually, again, they're based on the price, but the second derivative, and which we will touch on those in the next class. We've already talked about like MACDs, we talked about the stochastics, there's the moving averages, the RSIs, the CCIs. Those are all Bollinger Bands. They're all part of the modern. And I included Ichimoku, as you know, is one of my favorite charting tools. So that also could be considered a modern. So let's work on the classic side of things. And when we talk about classic, we look at patterns, and we look at, again, the prices, the trend lines. And by combination of those, we can actually read the investors and traders' emotional and the psychological reaction to the prices. So I wanted to use this little cheat sheet. So there are completely different patterns. There's a lot of them. These are the main ones, but there are probably more than 40, 50 patterns that you can find with completely really interesting names. But again, you see there are trend lines, there are the supports and resistances. From triangles, we have the channels, we have the double bottoms, the flags, the pennants, the double tops, head and shoulders. And then on the right side, I thought we can differentiate and use it for the like reversal patterns, the things that when the price actually changes, the direction, the trend, and then the continuing patterns such as the wedges, bullish rectangles, the channels, and then we have the bilateral patterns which go either way. So this is for your information. I'm not going to go too much about all of these because of interest of time. I'm going to share with you with four of my favorite, but also more popular and more profitable chart patterns. So let me start with this. Thomas Bulkowski, and we will talk about my favorite books. He's done extensive research on all these patterns for many years. He's written many articles on the technical analysis of stocks and commodities in that magazine, which is a great magazine, by the way, if you ever wanted to subscribe. So basically what he did extensive research to find out what is the best pattern as far as the returns goes, and statistically, what are the better probabilities of success. So as you can see, I want to share this. This is not a new one. This is an older one. He's been working on developing more studies. He's done about maybe gone through like 38,000 charts and look at the patterns. His book is one of my favorite. It's like really encyclopedia of patterns, charts, technical analysis. He just came out with the third edition. So I have the second edition. So he's updated this, but his favorite by far, when you're especially you're bullish and you see the bias to the upside, is the flags. And we're talking about these are bullish flags. So what I thought, let me share this with you. You can look at it. So I'm going to share one on the bullish side, his favorite, and then head and shoulder top when things top out, as when the bias is or the trend is changing. This is a good time. When there's a good time to get out of your positions. And according to him, actually the, the best return was the head and shoulder top. So we will do that, and a couple of my favorites that I will introduce you to. So let's start with the flags. And again, I'm going to look at more of a, we call it bull flag. So what the flags are, basically they look like a flag or the pennants. So these are called pennants. When there's a triangle and there's a like a channel or rectangle, it is called flag. So we have a pole, and this is the bullish side, and then either we could use like a wedge and like a triangle that becomes a pennant, or we could have flags like when there's a channeling or rectangle. And so that's the bullish, and then you also have the bearish. Normally, so this pattern is a continuation pattern. It's a continuing pattern. So when we are up, we will continue. When we have a breakout, when we are going down, we will continue going down. So this is like almost like a bull trap and bear trap in a sense. So that's visually, this is how the flags work. So in a sense, this is a little more colorful. What happens is we, let's say in the bearish flag, we go down, we're consolidating, and then we break down. This is the one I'm going to work on mostly on the bullish side. It has worked according to Bulkowski. This is like the best pattern when the trend is up, is using a pole, and then we have consolidation, and then we have a big breakout. So I will share my kind of a cheat sheet as far as my criteria for this. So, but visually you can see how it looks like, again, like a flag. So my criteria are that, again, we have that pole, we have a strong move up, and what happens, it could be a gap due to a catalyst such as the news. Something comes out, FDA approval, this takeover, or some kind of a news is very positive, or earnings that beat the expectations, or the projection of better sales. Whatever reason, you have a huge, really big move, which makes that big pull. So that's rule number one. So you want to have that strong move up. The second part is the consolidation. So now we've had, it's almost like a runner. We've been running up fast. We need to take a breather. So maybe there's a profit taking. So we have this consolidation that creates that rectangle or that flag. And we want to make sure it's that the consolidation is, at least in my opinion, it's about 15 to 20%. So you don't want to have a wide consolidation. You could be up to 25% of the pole if you want. The narrower, the better it is, and then we look for a big move. So basically, that's the top tightening. We like to see red candles. I would like to see at least 2 or 3 red candles, because of again, we are consolidating. We like to have a little selling, but not on a huge volume, which that brings us to the third one. As we are consolidating, we want the volume to dry out. That means the sellers, the profit takers are, they're done. They don't think there's any more, they think maybe they feel more positive. So that's one of the important things, that you want to have a lower volume during the consolidation. Now, what happens, your confirmation will be for your setup is the breakout, and the breakout will be the high of your channel, the high bar. We break out, but we want to make sure we do it on a high volume. I usually like to have a double of the average of the consolidation volume. So you want to have a high relative volume breakout. So volume is a key. So just pay attention to that to make sure it is not a false breakout. The fifth one is the target. So once we have that breakout, generally it's interesting that the move actually will take you to the length of the size of the pole, that the movement that initially we had, that it was gap up. Then once we do the breakout, it will continue and usually gets equal to that or close to that. So you can look at the targets that way. Sometimes you can even, we play the gap plays. You can maybe put the half of the length and take some of your profits at that target, and then have your second target at the full length of the pole. The stop loss is usually, it's again, we have this again consolidation area. You want to put it under the low of that area, and that will be your stop loss once you have the breakout. And or if you're using moving averages, which is really technical indicator in a sense, you can use a 20 exponential moving average as your support for your, again, for stop loss, anything underneath that. And the best thing about this, and that's the reason I want to share this, especially if you're doing day trading, this pattern works very well in a day trading, and 1 minute, 5 minutes, in any time frame. It could be good for 60 minutes, but also you can use it for weekly, on a daily. So that's what it makes it attractive. Okay, so that's the bull flag pattern. So what I wanted to do, just share with you, these are out of the oven earlier today. So it's not the end of the day. Today is the December 1st, 2021. Just give you some examples what that means when we say like the pole. Like for instance, you see there was a big gap up. This is on Arista Networks. And then you can see the consolidation. One problem I see is you have a lot of volume. So it's not, I'm kind of careful with this. Again, we have to look at the big markets as well too. What are the indexes doing? As you know, it's been pretty volatile week right now. So there's a lot of emotions and a lot of volatility. But generally, what we like to do, we like to have much lower volume and like to have a big volume breakout. So, but as far as it looks visually, this is one example. Just want to give you a few. Now, this is downtrending a little bit, but still it's a flag, and this is the pole. And here we are. We still have some volumes there. We do have our red candles. That's good, and we are way above our moving averages. So that's good. But again, there's a little too much volume for my taste. Something like this is good. So, and semiconductor. So you can see, again, we have the pole, and, it starts from the gap up all the way here. Now we are consolidating. We are ready, low volume. So if we have a big volume breakout out of 64, and basically we moved from like 48 to, let's say, 60, that's $12. And the channel has been about $4. So a little less than that. That's $3. So 3 divided by 20, 12, something about 13. That's about 20%. So that's still acceptable. So you don't want to have really a wide, like if it was at 58. So that's another example. And then we have the sprouts, the farmers market. Again, we have a big pole, and we have this really narrow consolidation with a small volume. So this is something to look at. So basically, these are just some of the ideas. The second part is the head and shoulder top, because you could have the head and shoulder bottom for buying. Head and shoulders are a favorite of many traders and investors. I think over the past few years, they have lost their glitter a little bit with a lot of program trading and other things, but I still think they have validity, as I will share a chart with you. So basically, head and shoulder it's like any, you can see we have a shoulder, which has a lower high, and then we have a head, which is a higher high. Then we can come back to the lower high. They don't have to be exact same height. So, and the neckline, this is a very perfect picture. Usually you don't have very clean, like a support line. So this is your neckline. Once we break through that, And again, I like to see more volume. I like to see on the uh, um, and the side of the shoulder, right side of the shoulder, I want to see lower volume. The volume usually has to dry up, and then we have a big volume on the downside. And usually the length of the travel or the price movement is from the head to the neck, and that's what your target will be. So this is a perfect picture. As I mentioned, they usually are not like straight line. They can be, uh, they could have some angles. So this is very clean, but that's what it is. So once it breaks down the conviction, then that's really gives you a good indication that, well, there is a new selling starting. The trend has changed. So it's a good time to take your profits if you don't want to, or you can start maybe shorting if you decided to have conviction. I want to share this. This is a 1 minute chart of today. Actually, we had a big gap up, a nice gap up. Obviously, the market was going up. And then what happened? This is only from, this is 11 o'clock West Coast time, Pacific Coast time. So as you know, toward the end of the day, we just had a big sell-off, obviously, news driven. But here it is. So we have this left shoulder, then we have the head, and we have the right shoulder. And this is the trend line. You can see there's an angle. And we consolidated, we tried. And if it goes back up, then that's a false, head and shoulder. And usually, if it's strong enough to go back up, usually will go beyond the high of the head. So, but here we couldn't, and we broke down. As you can see, the length of this was quickly traveled, and we went way beyond that. So that's a head and shoulder that you could use. The third one is one of my favorites, and it's the channel patterns. And you could use them rectangle or rectangulars, or the channels. You can go a rising channel, you have falling channel, you have sideways channel, which basically what you have support and resistance, and you're contained within that. Now we've talked about, let's say, squeeze, and a lot of times when, let's say, you're in the sideways channel, the volatility band is low. You can take advantage of that. In many option trading, this is one of the best tools I would recommend to use if you from vertical spreads to you want to do iron condors. These are really good pattern to take advantage of. So what I want to do, I want to share something. This is from like Finviz, finviz.com. It does it for you. For instance, this is again from today. You just go to the screen, and it will show you how it's done. So these are just some examples of the channels that it has developed in the past. You can see from March and April to now, like 8 months, 9 months. The longer the channel, the more valid. But then the breakout could be very volatile. So just be aware of that. But these can be a very good instruments for your, especially option trading. You can see how narrow this is. The next one, the fourth one, is one of my favorite, is the wedge pattern. And the wedge patterns they develop over 10 to 50 periods. You can use it on a daily, you can use it on 60 minutes, you can use it on 5 minutes. Basically, you should have about 10 to 50 periods. And it's like the converging of the trend line. So you have it could be a downtrend and uptrend, and basically almost looks like a triangle, and they converge, and the breakout of those could be very strong. So the way they look like this. So here we are. This is a uptrending wedge in the sense that, but the breakout could be either way. But once the breakout happens, again, the volume comes into picture. You want to make sure it's a again, higher relative volume, and basically the move is from the initial apex. I mean, from the move from the apex to the breakout is the length of from where we started. So if you broke up, this is the length of your travel in a sense, and it will go up. The same thing up right here. You can see the length. And then if you break down, this is how far it will go down. So this is important to Again, it is a pretty good uh, chart patterns for initiating a new position or getting out of your position. But most of the time I do it for initiating a new position, especially again using options. So I'm using Finviz, and basically you go to the screen. So what I did, like I said, well, on S&P 500, basically I want really liquid, especially if I'm going to play options on this. I want to go with the wedge, which is like a strong. And here are some of the candidates for us. This is a nice wedge. We are very much close to that apex. This one has already broken down, and this one looks like it's has broken down. Again, this is not end of the day. So this is, again, today's which is December 1st. And as you know, markets went down big time. But those are very attractive to me. So if you want to have like candidates for your classic patterns, what you could do, you can go to Finviz on the first home page. They actually give you some candidates, and basically they tell you, just by pressing on, let's say I want to go to just the wedge, not wedge up or wedge down or triangle, ascending triangle. They can actually, you can do the charts, you can look at the, again, the information about each one of them. So you can see we just talk about the print on the channel. There's a TSM. So it's a very valuable tool, the finviz.com, and it's free. So as long as you take those, there's a lot of ads. So that's the only annoying part. So the way you do it, you go to the screen. Again, I chose S&P 500, and you go to the pattern, and then here are all the patterns that you want to choose, and they're all there. And you can just basically choose your favorite one and look for candidates. I usually do that on the weekends, like on Saturday, if I want to see some candidates for the upcoming week. And you can also use that with ETFs and your major indexes and major ETFs. By all means, you can do that. So on the second segment, I like to share with you my favorite top 7 technical analysis books. These are the books that I actually have read them, and I've really enjoyed them. They are in my library, so there are hundreds and hundreds more, if not thousands, but these are the 7 that I have really enjoyed. So the first one is called Encyclopedia of Chart Patterns, as I mentioned, with Thomas Bulkowski. The edition came out, this is the third one, and it came out in 2021, actually earlier this year in the spring. So he has come out with more studies. As I mentioned, the one I've read is the second edition, the 2005 edition. Is fantastic. If you like a lot of analysis and looking at all kinds of studies done on these chart patterns, and it's classic. So he does a magnificent job. It's a big book, by the way, but it is, if you enjoy it, it's a great book. So I haven't seen this book yet. It has come out, as I mentioned, more studies done. The second recommendation is from Jack Schwager, and of course he is famous for Market Wizards interview and all the other ones, but he also had written in between, in the early 1990s, I think it was like 1994 5, he did a Jack Schwager on the futures, on the technical analysis of things. He also did the fundamental analysis, which I own, I've read both, and the technical analysis, that's very similar to what Bulkowski did. He did it before Thomas, but he also looked at all the patterns. He has done system trading. He looks at the past, and he likes to see the success ratio. And that's a really a good book. It's a pretty big book. So if you like to read and look at it, it's very informative. So I really enjoyed that. The technical analysis of stock trends. Now, this is the Bible, in a sense, of the classical patterns. It's Edwards and McGee. So initially when I started my trading, in the 1980s, this was the Bible to go to. Now, the one I have is from 1980s. believe it or not, the first edition came in 1948, and the second one was like 1951. So this goes back that long. Of course, we've had Thomas Gann from the 30s and 40s, and but the McGee had been really the Bible. So it has a lot of classic patterns, and again, that's also a big book. So if you're ever interested in charts, this is really good. Of course, Thomas Bulkowski and Jack, they've taken the information from them and they've gone a little farther than what we had before. The fourth one is, it's called Technical Analysis Explained by Martin Preng. Martin Preng is one of the smartest guys I know. I met him, and he was very big in the 80s and 90s and still around. He's written many books, including in the momentum trading, the psychology of the trading. Again, he's a very bright trader, but really educator too. So this is one of the really good books, and I would definitely recommend. It's not as big of a book as the other ones, and it's not about just going through all the analysis of, looking at the historical analysis. It actually explains all the chart patterns. I would, again, I enjoy reading all of his books, but this is really good if you want to continue with like classical technical analysis and also other indicators. The fifth one is, this is the second edition. I have the first edition, and it's called Technical Analysis from A to Z. This is a really simple book to read, and it explains all kinds of technical analysis tools. And I would encourage you, I think you might even find it in the libraries. It is a very easy to read, but as a reference, this will be a wonderful book to refer to. Again, I have all these books. This sixth book, by the way, as I mentioned, it's not the books that I've read other books, but these are the ones that I'm biased that I feel they've been good. I'm sure there are other books that I haven't read, but these are the ones I found useful. Now, John Murphy was the man as far as the go-to person in the late 80s, in the 80s and the 90s. He was on CNBC, their technical analyst, really. Every week they would have a session with him. He's written the Intermarket Analysis, one of the pioneers in that. And this book is a really good book. And it's a little more academic, but it's a wonderful book to have. Technical Analysis of the Financial Market. So that's John Murphy. He's again one of the best authorities on technical analysis. The last but not least is something a little different. So this is not a classic technical analysis book, as I mean, it's more of a modern, and again, it's the Japanese candlestick charting. And Steve Nissen, he actually went to Japan and started actually translating all the charts from all these, which was written in the 17th century, rice traders. And this is a fairly big book. He has a second part of candlestick charting, which marries some of the Western style trading. And but this is a fantastic book if you really into candlestick charting. As you know, I really like the candlesticks. So, and that's my last recommendation. And I hope it was helpful. As I mentioned, our next segment, what I like to do, I would like to work on the modern, and we discuss more about the different indicators or the derivative of this price technical analysis. With that in mind, I really appreciate your attention. I hope it was helpful, and we can open for Q&A. So we can stop the recording and open up for Q&A.